budget. Okay, and this is actually a big one these days because of COVID. And when COVID struck a year ago, a lot of people lost their jobs. Millions and millions of people lost their jobs. And so the guidelines for underwriting have become more and more strict, okay, with regards to income, okay, because literally 20 million people lost their jobs. And now people are going back to work now, but in many cases the job is part-time, right?
Yeah.
They might be going from a salary to an hourly. Can't use that. We need 24 months of history for that. So the budget has become very, very important, a very important topic. Now, a couple things I want to address with regards to budget is, one thing, what I call the sleep factor, okay? So what is sleep factor? That is the monthly payment that you can sleep with at night, okay? So we could qualify you for a really high monthly payment if you make a lot of money, right? And you get all excited about the house that you can buy with that payment. But 6 months from now, 9 months from now, a year from now, that payment is too strenuous on your budget, right? You're not able to go to Disneyland. You're not able to do the things, to live life, right? And so what I tell people, when we've given our seminars, I give them a 3x5 card, and I have them write down what they think their sleep factor is, okay? And so let's say they wrote down 3,500. Okay, now they're in our workshop. They're all excited. There's pizza and drinks, and so everybody's excited about buying a home. And so they write down this number on the 3x5 card, right? And they go home, and so they're still in euphoria, right? They're still super excited about this, right? So what I tell them, I say, take that card home and set it. I don't know if you can see it. Set it next to the coffee maker, okay? And so this is, I don't know if you can see that, let's say that's the coffee maker, right? And the reason I say that is because at night, when they got home, they're all excited and they go to sleep, they're dreaming about what's possible, right? Well, you wake up in the morning, right? And you wipe the sleep out of your eyes, you remember some bald guy and you're talking last night, you kind of forgot about all the details, right? You walk downstairs, where do we go first? The coffee maker, right? And so you go to the coffee maker, boom, you see this number, okay? Pay attention to the emotion of that event, okay? If you see that number and go, oh my God, that's too high, right? Then it's too high, right? You're gonna run into an issue in a year if that payment is not within your budget, within that sleep factor. You may look at that and go, piece of cake, right? We can make that work, right? And that's okay too. But the most important thing is to pay attention to what that monthly payment is, okay? It's incredibly important, okay? All right, now, we're gonna jump really quick. How is that payment determined, okay? With regards to the total payment, what I call the PITI, okay? And some of you may have heard that acronym, okay? So PITI. Okay? So this acronym represents the total monthly payment for the mortgage and owning a home, okay? So P and I stands for principal and interest. Yep. Okay? The T stands for taxes. So we all have to pay property taxes, unfortunately. And then the I stands for insurance. So you have to have home insurance, right? If the house burns down or burglars come in, you want to make sure it's covered, right? So when you're talking about the total payment, you're going to talk about this acronym, what we call PITI. Now, there's a couple things that are not included in here. For example, HOA, right? So if someone is buying a condo, for example, right? So that's going to come into play. But when you're determining your budget, okay, pay attention to the whole number. Okay, it's not just the mortgage payment. You want to include the budget for the property taxes, as well as home insurance and HOA and mortgage insurance if there's that, which we won't talk about today, but we can later. All right? Okay. Now, jumping forward really quick, there's a couple ratios that we want to pay real close attention to, okay? D DTI, okay, is another acronym which stands for debt to income. Exactly. Okay. Now, this is one of the most important ratio that we as loan officers care about. Okay. The DTI, or the debt to income, is your total PITI, the mortgage payment, plus your other obligations like school loans, car payments, credit card payments, divided into your gross income. Okay. So, simple math. Let's say we have a PITI equals 2,000, right? And then we have a income equals 6,000, right? If we divide 2,000 into 6,000, we get roughly 33%, right? So that means someone's DTI, or debt to income ratio, with these factors would be 33%. Now, what's acceptable, okay? That's going to be based on two things. Your sleep factor, right? So can you sleep with this payment at night, right? And this debt to income ratio, okay? Then you're in a good place. As a lender, as a loan officer, we can go much higher in most cases, right? We can go up to 49% or even above that in many cases. But that might be too high, right? So you can go as high as 45, 49, up and above, but you want to stay, most importantly, you want to stay within a ratio that's comfortable for you as a home buyer. Okay. Now, being in the Bay Area, we recognize that people push these limits,
way higher.
Way higher, yes, because home prices are so high. But so at any rate, don't feel pressure from anybody. The key is to pay attention to that sleep factor. All right, let us jump forward here. We talked a little bit about DTI. Now, one thing I want to mention is the last comment when it comes to budget. Back in, I don't have a mirror, but usually I have a prop with a big giant mirror, because back in 2008, 2009, before 2008, it was the guidelines for determining your qualifying approval were very loose. You could practically breathe on a mirror and get a mortgage with no money down, right? It was the wild, wild west of home financing, okay, and home buying. And of course, look what happened, right? When the economy tanked, biggest recession ever since the Great Depression. Now, since then, things have tightened, right? 2014, the government rolled out a set of rules, if you will, called ATR, which stands for Ability to Repay, that require lenders to require certain things from a homeowner or a home buyer, right? That people don't like, right? So people that don't feel like they feel like their income is much higher, and yet we have to interpret it a certain way. So my point with this is, it's hard not to get frustrated, but just recognize that the loan officer who's trying to get you qualified is not out to get you. We're not, we're in the business of closing loans, right, and helping people move into homes. So it's important to recognize that if you have unusual income, or maybe if you're self-employed, for example, that's a big example, or maybe you've transitioned from a salaried role to an hourly role, or another popular one is a salaried role to a 1099, right? So many people during COVID transitioned to a different position, different company, right? And so now they are being paid via 1099.
So independent contractor.
Correct. Yep. They're making a lot more money, right? Guess what? We need history of that, 2 years of that, if not more. And so sometimes people are making more.
And also, Dad, how about, like, I have people asking me, so now with all the help that people are getting from the government, all these stimulus payments, can they consider that as their income?
No.
When you're looking at their bank statements and everything?
You cannot consider that income.
Okay.
Yeah. Just like unemployment. So a lot of people took unemployment, right? Which I think is what you're referring to during the stimulus. Unemployment is only used if it's seasonal, and it's always, like if you're, let's say you pick strawberries in a field, right? And then 6 months out of the year, you're not picking strawberries, so you're on unemployment. That we can use, right? But if it's one-time unemployment, like during COVID, we can't use it. Right?
And how about those loans with the forgiveness loans, you know, the SB?
Yeah, so we can't use those for income. You can possibly use them for down payment, but I'm not quite sure about that in terms of the details of whether you can actually use that cash. But that's actually a very good question. Okay, we're going to transition to the C of ABCs. And if you remember, the C is credit. Okay?
One of the major points in the United States is having a good credit.
Yes, exactly. We love very good credit.
Right.
And back in 2008, 2007, you didn't have to have good credit. Okay? You could have very poor credit and still get a home. It's very different now. Okay? You absolutely need decent credit. Okay? Now, a couple things I want to highlight. Number one, and this is a topic that everybody brings up, and that is running your credit report, right? So we get calls all the time. Hey, can you get me qualified to buy a home? Here's what I'm looking for, but I don't want you to run my credit, right? And I say, in most cases, no. Okay, okay. Now, I'm willing to kind of throw it against the wall and see if see if it sticks with some of the information that they are providing. But for the most part, we have to run credit. Okay. Now, very important note: if you are shopping around and looking at different lenders, you're only going to be dinged negatively once. Is if you keep the credit inquiries within a 2-week period. Okay. So the credit bureaus give you 14 days to shop, whether it's for a car, credit card, school loan, whatever it is. So you can actually have your credit run multiple times in this 2-week window, and for the most part, the scores won't be affected negatively. Okay, if you go beyond that and keep running it, those inquiries will affect you negatively. Okay, but it's important to recognize that we have to run credit. We can't, qualify someone without it. Okay, now. One really important comment I want to make. Everybody sees their scores on Experian.com, which is a great company, or let's say your credit card. When you log in to look at your balance on your credit card, they say your credit score is right, or Credit Karma, which is a great company as well. None of those scores are valid for what we do. Okay, because when we run your credit, we have what are called risk overlays. Okay, so as a mortgage lender, we are determining your borrowing worthiness based on your history, right? And we have algorithms that go into the scoring methodology that determine the final scores. In many cases, the free services that give you your scores don't take any of those those risk overlays into play, and so your scores with those free services usually are much higher, right? And so it's important to note that whatever those scores are online are those are not usable. You can't use those scores. It's a good measure, right? If I see 750 online, that's a pretty good score, right? And if we run your score at 740, you're okay, right? But you cannot use those scores to determine whether you're able to borrow. Okay. All right. So. One thing I want to highlight really quick, a lot of people come to me and they have credit scores that are low, and they're low because of certain events in their lives, like medical bills that went to collections, for example, right? Missed car payments. Last year we had COVID, we had a lot of people missing a lot of payments, right? And many banks were allowing what we call deferment, where they could move the payment, right, to the end of the period. But I want to make it very clear to people that you don't have to just, like, let's say you got a late payment posted to your credit report, you do not have to live with that and just say, oh, woe is me. Okay, you have power to fix your credit. If you were to reach out to the creditor, not the credit bureaus, they can't do anything to fix it because they just report. If you reach out to the creditors and explain what's going on, explain why you might have missed this payment, many of them will offer deletion letters and submit those to the credit bureaus to help improve your credit. Now, you don't want to call them angry, right? You want to bring the honey, right, so to speak. So, but my point with credit is don't just live with bad credit. Take the time to fix it. And if you have any other questions about that, we can talk further offline. But,
Todd, what would be like the lowest credit score that a person can qualify to purchase a house?
Yeah, good question. So, depends on the type of loan you're getting. If you are doing an FHA mortgage, which is a government-sponsored mortgage, you can go down to 580, sometimes lower than that. Most of the bigger banks require higher than that, maybe 620. But in the 600 range, you can get an FHA loan. Conventional financing, which is Fannie Mae and Freddie Mac, that's a different type of financing, requires 620 and above. And of course, interest rates improve as the credit scores improve, right? So you might have a bad rate if you have a really bad credit score. So that's why it's always in your best interest to try to get your scores up as much as you possibly can, right?
So the higher your credit score, the better is your rate.
Absolutely, yes, without question. And that's actually the last slide. So the better your credit scores, the better your pricing, the better your interest rate. Now, a lot of times people will come to me, this is the last comment I'll make, and they'll say, I've got some debt I'm going to pay off, I've got some things I want to fix on my credit, so I don't want to fill out an application just yet, right? I suggest have the loan officer run the credit as soon as possible so they can review what the credit looks like and be able to advise them, right, on ways to fix it, right?
Right.
Because you're kind of going in the dark if you don't have advice from someone that you trust, with regards to your credit.
Yeah.
Okay?